Welcome to Jim Sells the Suncoast, your go-to podcast for all things real estate on Florida's beautiful Suncoast. I'm your host, Jim, your friendly neighborhood real estate agent, and each week we dive into the vibrant world of buying and selling homes while embracing the laid-back lifestyle that makes Florida such a paradise. In our episodes, we'll explore the latest developments shaping our communities and spotlight the incredible companies and industries that play a vital role in real estate, from movers to mortgage brokers, title agents to insurance pros. Whether you're a first-time buyer, a seasoned seller, or simply dreaming of that perfect beachside bungalow, we've got insights, tips, and plenty of local flavor to guide you. So grab your sunscreen and get ready to soak up knowledge, laughs, and a little sunshine as we navigate the Suncoast together. Let's make your real estate dreams a reality, one episode at a time. All right. Hi, and welcome to Jim Sells the Suncoast. Today, I'm honored to have John Lake from Shamrock Home Loans on. John is multifaceted. He's working in a couple of different areas, but he's familiar down here with the Suncoast. And we're going to talk a little bit about different kinds of mortgages, how to apply for them, what goes through the process of them. And then don't get fixated on that big number. Let's take a look at what you're actually going to live in. John, welcome.
Thank you. Thanks, Jim. And how are you today?
I am doing well. Very well.
Terrific. So when I start a conversation with a prospective borrower and client, most of the time what we try to focus in on is understanding the process, because we've heard horror stories about applying for a mortgage. When somebody makes an offer and that offer is accepted, people will pop the cork. The sellers, the buyers, the realtors, they pop the cork. Nobody on this little green plan of ours has ever popped the cork when they've applied for a mortgage. We want to take that into stride. Sadly, in today's world, because of technology, you can do this in an automated fashion. But if it's your first home, you are not getting the right guidance. You need to have that human factor. Because if you apply and you'll say pick a loan product, the difference between USDA, FHA, a conventional, we want to buy. And at that point, what ends up happening is interest rate. Where if you pick a different product, you might have a better chance of getting approved. So you need somebody to guide you and explain the process. I'm almost 3 decades into this business, so I try to make buying very easy. Our motto at Shamrock is keeping our clients excited from contract to keys. And we do that by taking them along step by step and educating them to make sure they understand what the process is all about. So when I talk to a new client, I always ask them, have you ever bought furniture you have to assemble? And most of them say, yes, we bought a table that we had to assemble just a short time ago. And I said, you get that box home, you open the box, you get everything out, you get a bag of bolts, and you get one tool. Two things happen. One, you have a very solid table, and it was a nice experience. Or two, the table's wobbly, your hands are bloodied, and you've learned a new methods. So we want to eliminate that second and put you through a process that you understand. So if we build a table together, the first thing we look at is your credit. So ask for some personal information to obtain a credit report. And that credit report tells us the almighty credit score is important. Right. And you get your credit card bill and it has a credit score, like, oh, I got good credit. But every industry has its own algorithm. And your credit score is based on a mathematical formula that each industry can adjust towards their risk tolerance. Your risk tolerance of getting a $500 credit card at the Gap is very different than a $500 loan from the lender. You want to start there. And the credit report is basically telling us a few things. The first thing it does tell us your score. And that score is made up of different things. How much credit you have versus what are your what kind of credit? Is it installment? Is it revolving? Is it a MasterCard? Is it a card? Is student loans? So there is so much that goes into this algorithm, and it spits out a number. And that number tells us how you've and that previous 2 years says this person good credit. Manage the credit. Now, I've had simple things where somebody has a couple of credit, maybe $500 limits, and what they have is $400 balances, and they pay it every month. But the algorithm doesn't understand that. So it says this person has used up most of their credit, so they're not managing it well. So we're going to give them a hit. So the profile report is important, as well as the second thing we take is your monthly minimum debt service. What is the monthly minimum payments on your account? And we take that data and mark over our second leg. Now, the second leg is important for the legs, and that is your ability to repay the loan. So we want to know exactly how do you get paid? Do you get paid as a W-2? Is there salary? Is it hourly? Is it overtime? Is there bonuses? Is there commission? Are you self-employed? Do you file a sole proprietorship, a Schedule C? Do you file joint return or a partnership? Are you an S corporation and you have P&L? We want to find out what you've made over the last 2 years so that we can see some sort of consistency in your income.
Right.
So if you're self-employed, we look at your net adjusted number after you've had some of your deductions, and you even add some of the deductions. We say, okay, this is what this person made the last 2 years. Is it trending up? Is it trending course, or is it trending down? So we look at that and say, this is what we're going to use for you. A salary employee, you don't get any bonuses. Yeah, $10,000 a month. And that's what we have to work. So we take that income, whether it's Freddie Mac, Fannie Mae, or even any of the government loans, they want your housing expense, what your mortgage payment is, principal, interest, your taxes, any HOA fees, any private mortgage insurance, and I'll explain that in a second. They want that number to be under 40%. Okay, we can go higher in some cases, but that's the target. And then we want to take that debt we took off your credit report, add it to the mortgage, and we like to keep that under 50%. But again, we can go a little higher in some cases. That's where we get some of your ranges on what you can afford. Okay. The third leg of
and this is your starting point, right? You pull all that information in, we say, hey, here's where we're going to start because we know what you can afford. And then you can start looking at how that's going to apply to the different options that you have.
And this is collecting the data portion of it. We want to know what you have to put down, because if you have less than 20% to put into the deal, and we have loans at 100%, we have loans cases that have some down payment assistance. In some communities, there's a lot of great programs there. But again, if you are managing your mortgage with an app, then chances are you're not going to be fully educated on what may be available to you. So we want to know what percentage, and we can do 0. We may have some down payment assistance, 3%, 3.5%, 5, 10, 15, 20. And that 20 is the magic number, because if you have 20% down, you're not obligated to pay private mortgage insurance. Now, what is PMI? It's an acronym. A lot of loan officers love to talk in acronyms. I don't understand a lot of acronyms. If your LTV is more than 80 and a PMI is going to be 0.5%, over the first 10, and then we're going to have to find out where your DTI is to tie it in to make sure we're getting the right PMI. Yep. It's just people, they look at you like, this is why we don't want to do this. But if it's explained properly, many years ago, when my parents wanted to buy a house and houses were like $7,000, $8,000, you had to have 30% down. And you also had to get a 10-year mortgage. That's it. That's how it was. No special financing. Then the New Deal came across and they said, we want people to own homes. It's the American dream. Why are you banks making this so hard? It's because lenders are usually risk adverse. That means we don't want to lose. We're in it for profit. We're for profit in an organization. So in the long run, we realized that if we had a partner with a down payment, the chances of us having to foreclose are very little, because you're going to walk away from equity. You'll sell the house before we can.
Right. If everybody's got skin in the game, everybody wants to win.
Right. So the government said, not everybody has 30%. And as prices go up and income doesn't move as much, it makes almost impossible for the average American. So what PMI is, an insurance policy, and it does protect the loan. And it's based on your down payment and that 20% mark. So if you're buying a house and you're putting down 10%, we now only have to insure 10%. Because if you fail, then we foreclose, we sell the house. And if it doesn't sell at 90%, we have an insurance policy that will pay it out. Down 5%, then we're going to insure 15% of the amount. So the bigger the loan amount and the higher the loan to value, we're going to need proper coverage. So it gives people an opportunity to buy a home with little down payment and have a manageable private mortgage insurance. Private mortgage insurance is not a dirty word or dirty words because they're becoming more inexpensive. Technology and stuff, it's become very inexpensive. So there's ways
that gives that borrower a chance to choose their own risk and choose their own level that they feel comfortable with. That, hey, you know what, 10%, I don't mind paying this, or 20% because I don't want to pay it at all. Whatever works for that, you can really tailor it to that individual borrower.
Just in your email the other day, the average sales price was what, 6 and change? 20%, $50,000.
Yeah.
That's a lot of money for someone starting out and come up with to buy it. So it makes it more difficult for the buyer to buy, and this makes it a little easier for everybody. So the down payment, we want to see where the down payment is. And then the last, which in Florida is a little less difficult because there are properties in all price ranges available for sale. So I qualified for 450 and there's really no house 50. It starts at 7. Really? So I can't buy a house because I'm limited by my ability to repay the loan. So that's a fantastic problem to have in Florida because you have options. Options means that there's availability and there's opportunity. So I'm very excited about the Florida market, even though it's not a seller's market, and those sellers are and they're staying in the house a little long. They're asking for more because a friend of a friend who has a cousin who knew somebody's brother who one time sold the house and got this price for it. So therefore my house must be worth it. So you know what that's like. So once we build this little model by obtaining a credit report, I become Noah. I collect 2 of everything. We ask for 2 pay stubs, 2 W-2s. If you're self-employed, we might ask for 2 years of tax. We're going to have 2 months of bank statements showing the money that the deal is available. You can gift, you can take they can come from neighborhood bosses. So we want to make sure you have access to liquidity. Then we give you a realtor that letter of credit, which means that we've done our diligence. We've underwritten this loan with credit reports, income, and asset documents. And here are the programs you're available. And now it's time to go out and play house hunters. Because we all know you just see 3 houses in one day and you pick a house over cocktails.
Absolutely. Super simple process.
Yeah,
So once they've gone through all these steps, now you're talking about what is the right loan for them? Or that's in that process where they're talking conventional, FHA, VA, USDA. The number of choices continues to grow.
It does, because we're getting back into some creative lending. But creative lending still all requires the ability to repay. I have people tell me that credit score is high. I'm like, that's terrific. Good for you. You've done a good job so far. But let's talk about your income. And that's where everything starts to fall apart. Some people, I'm self-employed, I can't buy a loan. That's not true. We have many loan types that can help people who may have the ability to take legal deductions in their taxes and show less of an income, but doesn't mean that you can't buy notes. We just have to go through a little alternative.
Right.
They're out there and available. Now, when you get out of that little box, realize that gentleman I used to work with says, the more you give me, the less I ask for. So you give me more money down, the less documents I'm going to require. And that's usually true, that we can find ways to make things happen, whether it's some of these new fancy loans, which just look at bank statements for self-employed people and stuff like that. We can usually come up with a way to do it.
So you mentioned a little bit earlier too, that magic paper that you give to your realtor, the pre-approval. The difference between a pre-approval and pre-qualify. There's a difference.
There is a big difference. To be pre-qualified, you and I just got pre-qualified without me asking you questions. Do you have good credit? Your credit card says 800. Okay. And what are your bills? They're about $300 a month. Okay. And what do you make? You make $100,000 a year. Okay. And what do you have in the bank? I have $150,000 in the bank. Okay. Based on this, and you want to buy that house for X amount of dollars, this number works and you're pre-qualified. But when I start pulling credit and I see that their score isn't exactly what they said because our algorithm is a little different. And well, you don't make that money, but you have the ability to make up to that money. But right now you haven't made that money in the last 2 years. So this is what you're trending, which is substantially less. And if you had this in the bank, you would eventually have that in the bank. So now all of a sudden you're sitting across from a seller with your buyer and you've given a pre-qual letter and they sign the agreement. And now you come and apply and we find out that we do not have a loan because we had a conversation. Approval is now we've done diligence. We've pulled credit. We've acquired your income and asset documents. And now we've reviewed everything. We've done an underwriting with an underwriter and through some of the automated underwriting processes that we have. So we're going to tell you that, we've done our diligence. All you have to do is find a house and we'll do diligence on that home. So
you've basically vetted, verified that information. And now you feel pretty good about this is going to work. So we can give a stamp of approval.
Oh, yeah. And that's what everybody should be looking for. I know a lot of listing agents, they'll see a pre-qual letter and they'll just pass. And that just gets over. We're not even entertaining, especially if you're in a situation where there are multiple offers. Pre-qual goes way to the bottom and you have to have something special about your offer that will make that go to the top because there are going to be cash offers. There's going to be people putting large amounts of down payment, some things that make your offer stronger than somebody who's
because the seller, at the end of the day, they want to reach that deal. And if there's things in there that may cause the deal to fall through, hey, you don't make quite what you said, or you don't have the actual rounding could be a terrible thing.
Yeah.
So the pre-qualify isn't as strong an offer, even if it looks good on paper, it hasn't been vetted.
We want to have a solid table from IKEA. We don't want a wobbly one. We want a solid one. And most people understand that once it's explained to them that a pre-qualification really isn't going to get you anywhere with offers. It'll get your heart broken, but it's not going to get you a house. So I always say that if you are ready to get into this and buy a house, well, let's get you set up so that we can maybe in multiple offers, make it a little quicker. Because if I've already got you through underwriting and approved, then I just have to have appraisal and title work to add into that package. So that cuts down on a lot of time. And maybe instead of 30-day close, we can do a 21-day close. We've done some pretty quick closings dependent upon where the borrower is in their stage of paperwork and getting us what we need as quickly as we need. And if I already have it, then I'm just now filling in an address on the application and we're ramping it up. And if we have to order stuff as a rush, it can be done. Versus finding out.
Speak a little bit. Yeah. Can you speak a little bit about the different types of loans and maybe the main ones, really conventional, FHA, very specific for VA, USDA. How do those apply? Is there one that stands out or any that may be particularly niche?
They're all pretty much have their own pros and cons. Freddie Mac and Fannie Mae, which are the conventional lenders, they typically have some of the better terms. However, they also have sometimes more difficult criteria to meet. If somebody's putting down 20%, they're going to be the go-to lender. If they're putting down 10%, they're probably going to be the go-to lender. The next would be the FHA, the Federal Housing Agency. And they are a good first-time homebuyer loan. They are more flexible. And they have certain things that make it a little better. For example, when I say private mortgage insurance, it's private mortgage because Freddie Mac and Fannie Mae don't offer it. So we as lenders have to go out externally and find that for you. And it's all credit and risk-based. So you have maybe a couple dings and a lower score, your PMI could end up being very FHA, whether you've got a 580 score or an 800 score, the PMI is the same because they are controlling the private cards. So it's the same number for everybody. So that's going to make somebody with a ding or two maybe a little better. The part about the FHA is that they require PMI on all of their loans. So if you're putting down 20%, and we don't need PMI, and maybe you're dinged up, you're still going to get a better deal with Freddie. Are putting less down and you're dinged up, FHA is going to be a better fit. Sometimes they have better terms for us, and they will be a little bit more flexible with things like debt to income ratios. They'll go a little 40, 39, and 49. They might go as high as 53. Again, dependent upon the circumstances and the right criteria. So the FHA is not a bad loan. They're too particular on their home. They do, because they're doing actual lending at 3.5%, and they want to make sure that a borrower is not going to go into a purchase with a house that's going to have holes in the wall, going to need a new roof, got a crack in the foundation, it's got this and that. So the appraiser does the look. They're not the home inspector. And they're just going to say, based on my guideline experience with the FHA, we have issues with the holes in the wall, the ceilings get holes, there's broken windows, and the roof should have somebody look at it and a professional give their opinion. So it creates some problems that maybe FHA don't care about. So we want to make sure that we're doing the right service. That's why, look at just rates. Somebody who's putting down 20% might see a better rate. Hey, getting some teaching on that is important. Now, a VA is veterans entitled to a benefit, and they have some great deals. So many down, no monthly private mortgage insurance. They're very flexible with their guidelines. Well, it's a great benefit for people who've done the right thing and served our country. So they are to it, and they deserve it. Then we have USDA, which is another great loan. They will also go to 100% financing, but they are looking at rural areas. So if you're in Bradenton or in Sarasota, you're probably not going to qualify because the population, and they go off census, is the city. But if you get out on the other side of 75, you've got farmlands. That's great area for USDA loans. Now, they do have income guidelines, meaning that they're there as the lender of last resort. And if you have 3 people in the house all working, they're going to want all 3, even out on the mortgage, they're going to want to see those income to make sure that household income meets their guidelines, because they do have guidelines in cap. So it's a great loan. And then we have the little bit more, I guess you would call them boutique type loans. And that's the right person, somebody who maybe is an investor, somebody who is self-employed, somebody who doesn't show a lot of money on their tax returns, but their bank statements have money coming in huge amounts. They have a good accountant who is taking full advantage of their deductions. We want you to report properly. You are entitled to deductions, and if you take them, then that's within the law. We don't want anybody who's going to deceive the government and end up in trouble. Those are new products coming into the market, and it's really for a particular group. And that's why somebody applying maybe online is going to get denied and not know why. I
think to your point, where that human element comes in is to walking through the different ones, because if I don't know the difference and I just have a selection screen, I'm randomly pressing buttons and then hoping that's what's going to work for me. Yeah. It might, but not necessarily.
You're risking something that you can end up, now you have to close because you're in the process and you realize that you made a big mistake and you got an FHA loan with PMI and you don't need it, and now you got it. And the only way to get rid of it is to refinance, which is going to cost you a little bit of money to do that. So the guidance on a purchase is invaluable when you're dealing with a human being. If you want to refinance, that's a whole different story. You've gone through the process. A lot of lenders out there will offer special deals, but I will caution everybody and realize this. We all get the money from the same place. We all have the same mortgage-backed securities that are selling at a certain particular price, and we all are going to have pretty much the same rates. So if you are getting an unbelievable rate that nobody else can meet, there's something there. You need to look at your loan estimate because they're charging you. I had one where the gentleman was telling me up and down that he's not paying any points. And I'm like, okay, they said, ask for a loan estimate and let me take a look at it. If it's better than I can do, then I'm going to wish you the best and send you on your way. And then it came across and I said, do you realize you're paying a $7,500 bank fee? And he said, well, what's that? I said, we would have called them points, but you're just paying a fee to do business with this company or get this better rate because they're giving you a deal, but they're making it back with what they're getting upfront in costs. So that APR is important in this particular case because even though my rate was higher, my APR was lower because we didn't charge anybody $7,500.
And we're seeing a lot of that now with the current environment and where the rates are. People are looking for ways to have a less expensive mortgage payment. So that brings up what you were just talking about, points. So let's talk a little bit. What are points? How can they be utilized to make a live in the mortgage and still make it affordable to buy the house?
Points are interest paid in advance. Okay. So if today's rate is 7%, and normally a point would reduce that rate by a quarter. So if you have a $500,000 loan and you paid a point, it would cost you $5,000, but you would save a quarter of a point on the payment. And that might not make enough of a difference to offset that $5,000 because it might only save you, let's say, $75 a month. And now, okay, how long do I have to keep this loan in order to recoup my $75? Now we are in a market that should be a declining rate market. And all of a sudden now you've paid $5,000 and you've got this rate of 6.375 or 6.75. And now you want to refinance. I was like, you just wasted that $5,000. Now, power of a reduced interest rate is huge. And we see builders do this where they say, okay, we're home sellers. We're home builders and home sellers. We just do the mortgage thing on the side to help facilitate the sale of a house. What they do is they just move part of their profit and they plunk a chunk of it down on the mortgage. So if you've got 3 or 4 points or percent of the mortgage that you can offset the rate, now all of a sudden you're down into the 5s. And that's huge. That could save you $200 or $300 a month and make it more affordable. Most fellows don't realize that they have the ability to do that. And we at Shamrock have a program called List and Lock, where if you have a house that's not selling, take a reduction. Let's say you've got a $600,000 house and you're going to take $20,000 of the price of that house. Now you have 580. If you've got somebody who's looking to buy and finance it, you've saved $20,000. Again, I go 10% of that is $2,000 less in your down payment, and now you have $140 less in your payment. Is that enough to move the needle to attract somebody to buy?
Right.
Now you give Shamrock and the seller, the buyer, that $20,000 in buy down of the interest rate, because that's all going towards interest. And what it's going to do is it's going to take your rate down from maybe 7 to 6.5. And at Shamrock, with our program, the seller signs up for it. We have a lot of marketing material for the seller to use, social media. We build a video. We give you signs. We have all kinds of great tools. We throw in a point so that 3% that you might be discounting is now 4%. And we're now looking at a rate maybe close to 6 or mid 6s. That's going to save you $300 or $400 a month. That moves the needle tremendously. So it's not only to the builder's advantage. Current houses that are existing can take advantage of the same thing. And we have a tool that will enhance it and make it a little bit more attractive because we're willing to be a part of it. And it's more than just the price of what a house is. When you look at what's going to make it affordable, who doesn't want to get something cheaper, but is that really going to be the best deal? You really got to look at it and leverage it. Is this going to save me a couple of dollars up front, but this one's going to save me money ongoing over the course of 30 years or until down the road you refinance or something? It can make the living day-to-day much better. And we just did that with a client who really liked the house. They were putting down some money, and it just wasn't working for them because it was more than they could afford. And even with a reduced offer, it still wasn't coming into where they wanted to be. So we have this program in our back pocket, and the seller was willing to throw in, and rather than take the discount and you're not going to buy the house, but let me give that discount to buy down your rate. And John's going to come with a point. And all of a sudden now, even though they were paying $25,000 more for the house, they were saving $100 on their payment compared to getting a discount at current rates. So it's a power of compounded interest and amortization. And if you stop buying things down in numbers, then all of a sudden now you're starting to save some real money. And the other advantage of that is you may not need to refinance. A couple of years ago, we had that marry the house and date the rate. People who took advantage of that, maybe haven't refinanced yet, but you know what? They've fallen in love with their rate because those were like in the low sixes. We haven't seen that in a long time. It's a long-term commitment. It's a home. Love where you live. A house for the sake of buying a house. Love where you live.
What are some of the common mistakes that the Suncoast residents make with mortgage, and how can they avoid them?
The rate is usually the last thing on the list of things you need to be aware of, because I can't effectively change the rate. You can't change the rate. Buyers can't change the rate. Affordability is my main driving. When I sit and have my consultation with my prospective borrowers and clients, we talk about what they qualify for. And I said, let's take that and put that aside. What can you afford? If you had to start making a mortgage payment July 1st, and that bill comes and you've got to pay it every month, tell me what's going to keep you up at night? Or will keep you up at night that you're not going to be happy in your home? And then let's work off of that and find a way to get you the most that we can. So focusing in on the wrong thing is usually what I see. I can get a rate here. I'm like, what does that mean?
Right.
It's the house. Stop. Look at the house. We're all going to be the same or close to the same. We're a mortgage bank. We're a independent mortgage lender. So we underwrite, fund the loans. We're not brokers. We're not going to farm them out to somebody. And all of a sudden a week goes by and you haven't gotten your disclosures yet because they haven't figured out who they're going to sell it to and they're out of compliance. We're going to pick a product based on the fact that we do offer all of it, and one that fits your needs. And having that conversation and taking the time to look at that before you go out and buy is important. And then the second thing is having somebody on your team who, before you make the offer, you call your lender and you have a consultation. So, John, this is the house. We love it. Jim found us the house and we want it. And here's the asking price. This is what we've talked to Jim about making the offer at. We want to know what these numbers mean. So many people go into negotiations without realizing the difference between their offer, what the asking price is, any deviation in any of that along the way, in counter offers. They go into it completely blind of understanding the process. And I'll share a quick story with you because I know we're time sensitive. I had a gentleman who came in and I got him pre-approved. And we got everybody happy, his wife, his two kids. We all had a great time. And they were out looking for houses and they kept getting offers rejected. And they came close to one. And I said, well, come back in. We need to have another meeting because we got to make sure you're doing the right steps because you're not calling me. And he sat down and close to me. His wife had taken the kids to the restrooms. And he said, John, this was the house. We were so close. We made an offer. They counter offered us. They're $10,000 apart. And I still to give them. I'm like, dude, you're not giving them $10,000. You're giving them $1,000, and it's a difference of $58 in your payment. And this is the part of the story that I'll never ever forget. The fear in that man's eyes when I told him that, and he looked at me, and he said, "He's going to say this to my wife," because he didn't take the time and ask the right questions, and he would have gotten the right answers, and they would have been in that house because the kids had already picked up their bit. He had the fear of his wife in him.
Yeah, so, you know what? 100% right there. When you have that team that you're assembling, because when you're buying a house or you're selling a house, you have a team. You've got You've got your real estate agent, you've got your lender, you've got your insurance person. You're going to go through all the steps. They're there to make sure you're happy with what you're picking. And then so you don't step into anything that you don't want to step into. So utilize the team. If you set up the team but don't use them,
then you might end up failing. Yes.
Yeah.
So,
John, I could sit here and talk for you for hours. I always learn something and love it. So thank you so much for joining me. I really appreciate it.
My pleasure.
And hopefully we'll do this again soon.
I hope so. And hopefully it'll be warmer here one day. But I can't wait to get back to my sunny, warm Florida home. I do miss it so much. It's a great
place. Keep the sun
on
for you.
It's a great place to live. So, Jim, thank you.
And that wraps up another sunny episode of Jim Sells the Suncoast. Thank you for joining me on this journey through the ins and outs of buying and selling homes here in our beautiful slice of Florida. I hope you found valuable insights and a little bit of inspiration to help you on your real estate adventure. Remember, whether you're looking to buy, sell, or simply soak up the Suncoast lifestyle, I'm here to guide you every step of the way. Don't forget to subscribe and leave a review so that we can keep shining bright together. Until next time, keep dreaming big and let's turn those dreams into a reality, one home at a time.